Hello world, Stuart here again, aka the Prudent Programmer. Welcome back to my study on this gloriously hot day in Sheffield. Today I'm going to walk through my thoughts on what an interest-only mortgage is, the pitfalls, the disadvantages and advantages, and how it can be used for you in the right circumstances to beat the odds a bit and actually reduce the term on your mortgage and save you a lot of money. Many bloggers and YouTubers will tell you that the best way to save you money on your mortgage is by overpaying it each month. Now I'm going to suggest a slightly different strategy, which may seem counterintuitive, but hear me out on this one. It's to pay down as little of the mortgage on an interest-only mortgage per month and use the difference to invest in the stock market. Before I go into the details of how it can save you money, it's worth noting and understanding what an interest-only mortgage actually is. So I'll go into that now. This type of mortgage, as the name suggests, is one where you pay the interest only on that mortgage. So at the end of the mortgage term, you won't have paid off any of the capital. Let's say you want to buy a property worth £200,000 and you have £30,000 as a deposit. Then you get an interest-only mortgage for 25 years at 2%. This means your monthly payments are £284 per month, and the total interest paid over 25 years is £85,065. Yes, I can already hear the infuriated screams from people saying that at the end of the term, to those 25 years, you won't actually own the house. You'll still have to pay £170,000. So let's pivot that thinking and try and use that as a strategy to actually pay it off earlier. So let's imagine the same property, £200,000, £30,000 deposit, is bought on a repayment mortgage of around the same percent, so 2% for 25 years. This means that your monthly payments will be £721 per month. So let's now take the difference between the repayment mortgage and the interest-only mortgage and use that to invest in the stock market. If you can afford the difference between those two pieces, then using an interest-only mortgage could be beneficial for you. So you go down the route of the interest-only mortgage along the lines of that you could also pay the repayment mortgage if you needed to. So that means the difference between those two figures, those two monthly figures, is £437 per month. So let's use that £437 to invest in a low-cost index fund where the nominal returns are around 6% per year. This means that you'll be paying off your mortgage balance after about 18 years and 2 months. So a whole 6 years and 10 months earlier than the term of the mortgage. And that's it, really. You've now paid off your mortgage in around 2/3 of the time it takes to usually pay it off if you had a repayment mortgage. But actually, that's not just it, because there are some inherent risks when it comes to this type of mortgage. So if, for example, the point where you have to pay off the mortgage, the economy goes down into recession and the value of your funds goes down as well, it means you could have a shortfall when it comes to trying to pay off your mortgage. You still have to pay the mortgage, so you have to make up that shortfall from somewhere. This method also relies on the interest rates being as low as possible on that interest-only mortgage for the lifetime of the mortgage, and the returns from the stock market being as high as possible. If there's a long period where that changes, then you may miss out or you may lose out in the long term. Not only that, it relies on you sticking to the strategy yourself. If you had a repayment mortgage, for example, and you stopped paying that £437 per month difference, then the bank would likely repossess your house, and that's an immediate repercussion. However, if you stop paying that £437 into a stocks and shares ISA or something that will make that 6% return per year, it means that the only time you'll see the repercussions of it are at the end when you have to actually pay it off. So this is relying on somebody who has that kind of financial fortitude to hold for the long term in order to reap those gains. To show how these risks can play out, it's worth looking to the past and seeing how they have already played out. So back in the 1980s, there was mortgages that you could get called endowment mortgages. And these worked by you having an agreement with the mortgage lender where you would have an interest-only mortgage. You would also have an agreement with the insurer where you would pay them a lump sum per month in the same way you might put towards a stock and shares ISA or your own investment. And then the insurer at the end of the term of the mortgage would then pay off your capital repayment part of that mortgage. So the strategy is almost exactly the same as you would be taking yourself. So why don't they exist now? What went wrong? What went wrong was that at the time, in the 1980s, at the height of their popularity, inflation was quite high, which meant that the returns on the insurer's part were quite high as well, between sort of 7 and 12%. But this all changed when inflation came down, and this means the nominal returns from these funds the insurers put into also dropped to around 4% in some cases. It meant that the insurer couldn't pay off your interest-only mortgage. Looking at these risks and potential rewards, it means it's important to understand those risks and make sure that you have the financial fortitude, like I said, to push onward in the long term, understand that things may go up or down, and therefore you have to keep an eye on things yourself. Despite all this, however, you'll still find that many large property investors use this strategy as a means of extracting the largest return on investment in conjunction with refurbishment or rising property prices in certain areas. So to summarize, this strategy isn't for everyone, and in fact, I'd advise against it for most people. But if you think you can have the financial fortitude to see it through to the end, and that you have the ability to have gains from a fund which outpace the mortgage interest and the fees involved there, then it might be a strategy that could work for you. Just understand the risks, but also you can still do it. That's it for now. If you've enjoyed this content, then feel free to subscribe because I'll be making some more videos per week. And please like if you have. And thank you for watching. Bye.